sole proprietorship, partnership, limited liability company, or corporation. If you are wondering how to choose a Texas business entity, this presentation is for you. A sole proprietorship forms when you start a business without forming a business entity with the state. Sole proprietorships are the simplest form of business entity. They are relatively easy to establish and maintain. They typically require few, if any, state filings. They do not require corporate formalities like business meetings or officers. Sole proprietors have complete control over their businesses. They do not report to partners, shareholders, or board members. The owner can easily transfer its assets and goodwill, for example, to a child who wishes to continue the business. Finally, sole proprietorships are not subject to the state franchise tax. On the other hand, there are no limits to the owner's liability. They are personally responsible for everything related to the business. From the perspective of creditors, plaintiffs' attorneys, and taxing agencies, the sole proprietorship's assets are the owner's assets. Sole proprietors may have trouble establishing credibility with potential customers and lenders, and because sole proprietorships have only one owner, they cannot sell stock or otherwise raise large amounts of capital and scale up. Like sole proprietorships, general partnerships spawn spontaneously. They exist wherever two or more persons conduct business for profit. General partnerships are easy to establish and maintain. They do not pay formation filing fees or have to keep corporate formalities. In fact, they are often formed unintentionally. Partners can support one another, complement each other's strengths and expertise, and relieve one another of sole responsibility for the business. Because taxes pass through to the partners, they escape the double taxation of corporations. General partnerships can avoid the franchise tax. Although general partnerships by themselves do not avoid limited liability in Texas, they do enjoy charging order protection. Charging order protection protects the business from the obligations of and claims against the owners. The owner's creditors cannot reach the business assets, but get only a charging order entitling them to distributions made to the debtor owner. If the business makes no distributions, the creditor gets nothing. Texas law grants charging order protection to partnerships and to LLCs. In September 2023, Texas joined a small group of states that provide charging order protection to single-member LLCs. On the other hand, the owners of general partnerships are jointly and severally liable for the entity's obligations and for each other's actions. The partnership may end if the owners disagree or one calls it quits, or if one dies. And because the only owners are the partners, they cannot sell stock to raise capital. A limited partnership has both general and limited partners. General partners run the business, while limited partners do not. Limited partnerships are a good deal for the limited partners, who generally can lose no more than what they invested in the business. They share in the profits and losses without having to be involved in management. That can make management simpler for the general partners who run the business. They do not have to consult with the limited partners for most decisions. The partners receive pass-through tax treatment, meaning that the profits are not taxed at the entity level. Depending on the structure of the partnership, partners may also enjoy charging order protection. However, limited partnerships may not be a good deal for the general partners. General partners are liable for the entity's obligations and for each other's actions. Some tricks can limit this liability, for example, using a corporation as a general partner. Limited partners may not appreciate their lack of control. Limited partnerships must pay the Texas Secretary of State a $750 formation fee, and they must pay the Texas franchise tax. Small businesses with annual receipts below $1.23 million pay no franchise tax. This is known as the no tax due threshold. Businesses that earn less than $20 million in annual revenue and file taxes using the state's EZ computation form pay a franchise tax of 0.331%. The tax for retail and wholesale companies is 0.375%, while the tax for other companies is 0.75%. This tax is assessed on taxable margins, which are the lowest of 70% of total revenue, 100% of revenue minus costs of goods sold, or 100% of revenue minus total compensation. This tax is due on all businesses in Texas except sole proprietorships and general partnerships. To obtain additional liability protection, a general or limited partnership may register as a limited liability partnership or limited liability limited partnership. Registering as a limited liability partnership or a limited liability limited partnership, you guessed it, limits the liability of the general partners in the underlying partnerships. Texas, unlike other states, does not restrict this protection to partnerships of professionals such as doctors and lawyers. While partners are liable for their own wrongful acts and those of the individuals they supervise, their personal assets are protected from claims based on the wrongful acts of other partners. Partners can also avoid personal liability for the partnership's debts and obligations. These partnerships may also enjoy charging order protection. Texas LLPs and LLLPs must pay regular filing and registration fees, including a $200 annual registration fee per partner. These entities are subject to the annual franchise tax. Finally, an LLP or LLLP must maintain at least $100,000 in liability insurance. Limited liability companies. The greatest reason to form an LLC is in the name, to enjoy limited liability. An LLC is an entity distinct from its owners, responsible for its own debts and obligations. If the company faces a lawsuit or financial liability, the owner's personal assets are protected from claims against the business. Only the assets of the business itself are at risk. This limited liability can be lost through piercing the corporate veil, which can happen when owners fail to observe corporate formalities or fail to distinguish their assets from business assets. Limited liability also will not protect the owners from their own personal misconduct related to the business. In addition to enjoying limited liability, LLCs are incredibly flexible. They can issue various classes of ownership interest. They can be controlled however the owners determine in the operating agreement. And they can be taxed as disregarded entities, partnerships, C Corps, or S Corps. LLCs have few corporate formalities, such as meetings and boards of directors, making them easy to operate and maintain. Texas gives charging order protection to both multi-member and single-member LLCs. LLCs are great for holding real estate investments. On the other hand, Texas charges a $300 LLC formation fee. The law governing LLCs is less certain than the laws governing corporations, since LLCs have been in Texas only since 1991. Because of their limited liability, LLCs may have difficulty raising funds. Finally, the LLC may be subject to a franchise tax if its gross receipts exceed the zero tax threshold. A corporation or C Corp is a business in which the owners, also called shareholders, are taxed separately from the entity itself. Under state law, shareholders of a corporation are generally protected from liability for the corporation's obligations. The most they can lose is their investment, if they observe corporate formalities. However, officers may be personally liable for the corporation's obligations. Corporations are especially useful for businesses that wish to go public, raise large amounts of capital, and scale up. There is no limit on the number of shareholders, and shareholders can easily buy and sell their ownership interests. Furthermore, in theory, corporations can exist forever. But C Corps require much time and expense to establish and maintain. Bylaws must be carefully drafted, a board of directors should be appointed, shareholder agreements must be precisely spelled out, stock certificates must be issued. Corporate formalities must be strictly followed. A board of directors must be maintained. Regular meetings must be held, etc. Corporations are subject to enhanced supervision by state and federal regulatory agencies, including the U.S. Securities and Exchange Commission. A shareholder's creditors can reach all of the shareholders' interest in the C Corp, including rights to distribution and management. Shareholders do not enjoy charging order protection. C Corps are not good for holding investment properties. They have too many adverse tax consequences. The profits of C Corps are subject to double taxation. First, the C Corp pays federal taxes at the federal corporate tax rate of 21%. Businesses with annual revenue over the no tax due threshold must also pay the Texas franchise tax. Then, shareholders pay income tax on the dividends in their personal federal tax return. Texas itself does not have an income tax. An S Corp is not a distinct entity, but an LLC or C Corp that elects to have income tax flow through the corporation and directly to the shareholder. In addition to the advantages of the underlying LLC or C Corp, an S Corp enjoys certain tax advantages. The S Corp pays its owner a reasonable salary, on which the owner pays self-employment tax. Above the reasonable salary, distributions are not subject to the 15.3% self-employment tax. This can save significant self-employment taxes for the small business owner who makes more than enough to cover a reasonable salary. In addition to the disadvantages of the underlying LLC or C Corp, S Corps face numerous restrictions. They can have no more than 100 shareholders. Shareholders must be U.S. citizens or permanent residents. The S Corp cannot derive more than 25% of its income from passive activities. Business entities and trusts cannot be shareholders. And S Corps can issue only one class of share. Did you choose the wrong entity for your business? If so, you can probably change your business entity. This is easy for sole proprietorships, more complex for partnerships, LLCs, and corporations, but it often can be done. I'm Daniel Van Slyke, an Aggie attorney licensed in Texas, California, and Missouri. You can find me at iplanlaw.com or email me at daniel@iplanlaw.com.